Welcome to The Explainer. Today, we're decoding what is arguably one of the most brilliantly engineered and, let's be real, heavily scrutinized digital assets out there. We're talking about the economic mechanics behind BNB. This isn't just your standard story about a coin, right? It's actually a fascinating look at how you can program an economic engine using pure supply and demand, and what happens when that exact engine collides head-on with real-world financial regulations.
15 cents. Just let that sink in for a second. Back in the summer of 2017, during its initial coin offering, a single BNB token cost just 15 cents. Fast forward to its peak, and we're talking about an asset whose market cap surged past $110 billion, totally outperforming a lot of major players in the space. So how exactly do you build a multi-billion-dollar empire starting from a 15-cent baseline? Let's unpack it.
Okay, let's dive into this. We've got a clear roadmap for our explainer today. 1. The rise of BNB. 2. Driving demand through utility. 3. Shrinking supply, token burns. 4. Centralization and regulatory scrutiny. And 5. The tokenomics value engine. All right, section 1. The rise of BNB from ICO to ecosystem. So BNB hit the scene in July 2017, launched by Binance founder Changpeng Zhao, who everyone just calls CZ. Interestingly, it actually started out as a basic ERC20 token, which is just a standard type of digital asset, living on the Ethereum network. But trace the rapid evolution here. By April 2019, Binance migrated BNB over to its own native blockchain. Then in September 2020, they launched the Binance Smart Chain. This was huge. It completely transformed BNB from a mere exchange voucher into the absolute essential gas, the mandatory fee you have to pay to run a transaction, powering an entire massive parallel financial infrastructure.
Moving on to section 2, driving demand through utility, the engine of demand. To really get how this economic seesaw works, we have to look at the demand side first. Binance research points out something absolutely crucial. A token's fundamental value isn't just built on hype, it has to be rooted in actual utility. Think about it. If you want people to hold on to an asset, you've got to give them compelling real-world reasons to use it. That utility is what creates sticky organic demand.
And BNB has built an incredibly sticky ecosystem by offering all sorts of utility. It's basically the Swiss Army knife of crypto. You can use it as a tool to get discounted trading fees. It's a value exchange. I mean, you can literally book flights on Travala or even buy real estate with it. It functions as the required gas for the Binance Smart Chain. You can earn yield via Binance Launch Pool and staking, and of course, it acts as a currency at millions of global merchants. But honestly, the most brilliant behavioral hook here is this super simple journey. Step 1, you buy BNB. Step 2, you use it to pay your trading fees on Binance. Step 3, you get an automatic 25% discount. It directly saves you money. It's kind of like getting a massive discount at your favorite store, but only if you use their specific loyalty points. As one former executive put it, this incentive makes customers act a little bit more like owners. Their interests perfectly align with the platform because holding the token literally pays off. Okay, section 3, shrinking supply, token burns, the deflationary mechanism. So if utility pumps up the demand, token burns manage the exact opposite side of the seesaw, the supply. Let's define this clearly so we're all on the same page. A token burn is exactly what it sounds like, permanently destroying tokens to remove them from the circulating supply. It's a programmed deflationary mechanism. Basically, if demand stays the same or goes up, but the supply shrinks, the asset naturally becomes more scarce. And BNB executes this on 2 different fronts to crank up that scarcity. First, they have a quarterly auto burn, which historically has been tied to the platform's profitability and trading volume. Second, they rolled out the BEP95 upgrade. This destroys a portion of the gas fees spent by users on the network in real time. So the more the network is used, the more BNB is permanently wiped out of existence. What's the ultimate goal here? Well, back in their original 2017 white paper, Binance pledged to use platform profits to buy back and burn exactly half of the 200 million BNB ever created. They are steadily marching toward that 100 million token target, with almost 20% of the total supply already gone forever. Founder CZ summed this up brilliantly when he said, "Financially, that works the same way as a dividend. Economically, it's such a great analogy. Just like a traditional corporation uses its profits to buy back its own stock, reducing supply and making the remaining shares more valuable, BNB uses token burns to consolidate value. It is a masterclass in programmed scarcity." All right, let's pivot to section 4, centralization and regulatory scrutiny, the reality check. Now, as you might guess, an economic design that acts a whole lot like corporate stock is absolutely going to attract regulators.
The SEC has taken a firm stance in its lawsuit against Binance, classifying BNB as an unregistered security. Their argument? Because the token's price relies so heavily on those deflationary burns and the utility built by Binance's corporate team, buying BNB is essentially, quote, an investment in the success of the platform itself. The SEC backs this up by pointing straight to internal communications. For instance, in a 2017 Reddit Ask Me Anything, CZ explicitly stated that the value of the coin is heavily associated with how well the platform does. Regulators use statements just like that to argue investors bought the token with a reasonable expectation of profit derived from Binance's entrepreneurial efforts, which, legally speaking, fits the definition of a security perfectly. And it's not just the regulators raising alarms here. A major forensic investigation by Forbes highlighted some staggering centralization risks. After doing deep on-chain analysis, Forbes alleges that Binance and its founders secretly control roughly 76% of the total circulating BNB supply. That is a massive level of centralization. The Forbes team dug deep into that original 2017 ICO and came back with some wild claims. They alleged the ICO was actually a near failure, raising less than $5 million, not the heavily publicized $15 million. On top of that, they claim that instead of 100 million tokens going to the public, only about 10.7 million actually did. The remaining 65 million supposedly unsold tokens, Forbes says those quietly moved right into Binance-controlled corporate wallets. They warn this gives the platform the potential to artificially inflate prices and trading volume. Now, to be fair, Binance representatives have strongly disputed these claims, calling them completely unfounded and dismissing them as just fear, uncertainty, and doubt.
Finally, Section 5. The tokenomics value engine, synthesizing the views.
Let's bring all this together. We're basically left with two completely opposite views of the exact same asset. On one side, you have a brilliantly engineered deflationary utility token. It's powered by massive ecosystem demand and program scarcity that theoretically drives the value up. But on the flip side, regulators and journalists see an unregistered security. To them, it's a highly centralized asset heavily dependent on a single corporation's success and tightly controlled supply.
Which leaves us with one incredibly provocative question. We've seen how token burns and discounted utility can create undeniable market value on paper, but as the gap between decentralized ideals and centralized reality starts to close, can a token engineered for perfect supply and demand mechanics survive the ultimate test of regulatory reality? That is the billion-dollar question for the future of digital assets. Thanks for joining me on this explainer, and always keep questioning what's under the hood.